wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Continuing our mission to help people discover, protect, and share true financial independence, this is the Get Ready for the Future show for another week. My name is Scott Inman, and welcome in John Shrewsbury, one of the co-founders of GenWealth Financial Advisors, alongside today as we get set to answer your questions about money, about investing, about retirement plans. And John, it never escapes me, I should say, when I read the questions in advance that we get from our viewers and listeners about how complicated, first of all, that retirement is. And it also is evident to me that people they seek advice, they want help, they don't want to go it alone. But yet, at the same time, sometimes we get a little microscopic in our thinking. And I think that we're going to see that today, and we're going to walk through some things and give you some details on some things. But sometimes we struggle to see the forest for the trees because we hear about something, we think, well, maybe that might work. I might need to do that. Or, hey, I've heard about this. Maybe I should do that. In the meantime, the broader concept of the overall planning process may be what needs to be fixed first.
You're absolutely right, Scott. And when you think about the need, then that broader context is always important. And I've been kind of on a little bit of a rant around the office these days about this particular issue. And that is, I think sometimes when you are trying to deal with a problem, you get tunnel vision. Mm-hmm. And sometimes you have to get outside the box. Matter of fact, sometimes you have to kick the sides out of the box and expand your thinking about something. And I think that oftentimes we get tunnel vision about things in our finances, and we just don't think outside the box enough to understand that there are a lot of alternatives out there, not just what you may be thinking about to try to solve the problem that might be right in front of you.
And don't take your advice from Google. I hope you're not doing that for sure. You get some professional guidance on your journey to financial independence. And I know that's it's a concept that people sometimes don't really understand or don't really believe that they can achieve. And the reality is it's out there and attainable for everyone, but you have to make the right financial decisions and do it over a long period of time to reach it. So that's our soapbox. We tend to start there on the Get Ready for the Future show. We'll climb down now, and we'll get into our questions today. So first up, it's Beverly from Maumelle. We're 57 and have a paid-off house worth $500,000, but not much in retirement savings. Should we consider a reverse mortgage later on? We'd call this house rich, maybe cash poor. Is a reverse mortgage the right tool, or just a last resort? Let's break down the pros and cons here. And first of all, we'll start with a little bit of a disclaimer. We cannot recommend to anyone, and certainly wouldn't on the radio or online anyway, a reverse mortgage. So the context that we will be discussing the reverse mortgage is going to be education only. But a reverse mortgage, if you feel like it's something you want to do, we do think you should treat it as a last resort. We need to probably talk a little bit about what a reverse mortgage is.
Yeah, so a reverse mortgage is offered to people that are beyond age 62, at 62 or older, and it is exactly what it sounds like. It is a reversal of a mortgage payment. So you've been paying a mortgage all this time, building up equity in your house. The proposition of a reverse mortgage is that the bank's going to just simply turn that situation around, and they're going to calculate an amount of money that they would send you from the value of your home on a monthly basis. Now, you still own the home during this time, but at the end of your life, when you're gone, then the bank has the ability to sell that home and extract back the funds that they paid you, probably plus some interest. So it is a way to create maybe a stream of income, Scott, but I think that there's a lot of warts on that, and can be a lot of warts on that, because you got to think about, okay, am I going to get the value out of it? Mm-hmm. And is that something that is a good financial deal? And what does that mean for my heirs? Do I want this house to be part of my estate and all of those things? So there is a lot of complexity to that. And I think that before I would do this, I would tell you that I would think long and hard about the possibility of maybe selling the house and finding someplace to go rent or something like that, to be able to actually have 100% of the capital, because you know that the bank is not going to calculate this based on the full value of the house, because there's no upside for them in that situation.
Yeah, that's a great point, because really that's what you're doing. You're renting your own house by taking the equity out of it. And I think the problems really lie at the end of that period, because you would still own the home and you would not make monthly mortgage payments until you no longer live in the home, and then the loan has to be repaid. So you think about, there's really only two ways that happens. Well, I guess three if you did, as John said, sell the house. But typically, if you're not going to go the rent route, you're either going to pass away or you're going to go into assisted living or nursing home care. And then what happens? You have to repay that loan. And if you're still living, how are you going to do it? You'll be forced to sell the home. And to John's point, you would likely not be able to get the value that you want out of it if you're forced to sell in a time where you need to do it quickly, or you leave it to your heirs if you pass away, and then they have to deal with it, which of course could eat up the estate, or they would have to deal with paying mortgage payments or keeping up the house while it is for sale. So it's wrought with problems at the end of this. I can understand if you don't have much in retirement savings, why you might be looking at all options, and you should consider all options on the table. But I think the thing that stands out to me here, John, is if they're 57 and Beverly's not indicating when they want to retire, but let's just assume an average retirement age, which in this country is 65 years old. Most people like to get the Medicare age and be able to get those benefits, and that's when most commonly people retire. If we just apply that, well, let's assume you're retiring at age 65 as an example. You've got time to bolster your retirement savings. Now, that may not seem like that's really going to matter, but if you have recently paid off your mortgage, you could easily start contributing the amount of your monthly mortgage payment. I think that's the first place to start. So let's do some math on that.
Yeah, if you do that, $1,500 a month, if you got an 8% rate of return over that period of time, hypothetically, you could get 8% by being maybe in a long-term stock fund or something like that, then you could have over $200,000 saved up, which is about half of the value, roughly half the value of the mortgage, or of the value of the home, rather. And so I think that you just, again, got to step back from that. But, Scott, I want to point out one other thing in this particular situation that is instructive to maybe some of the younger people that are not saving for retirement right now.
Yeah.
Don't get yourself in this situation where you are now forced to essentially liquidate on a monthly basis the only asset that you have. That is not a wonderful place to be as far as your financial independence is concerned. As a matter of fact, that is not financial independence. You've got to be in a situation where you are regularly putting away money toward your retirement. It has got to be a priority, lest you find yourself trying to, basically liquidate the assets that you have to try to create some sort of income.
And we said at the open, too, that it is available. Financial independence is available to anyone. You just have to make the right financial decisions. And when you're walking through that, looking at this from a young person's perspective, I kind of draw back on a conversation I had just yesterday with a client. It was a client couple coming in, and they're about to retire in a year. And they are ready. They're going to have a couple of pensions. They're federal employees, and they will have about $2 million saved in retirement savings. They're going to have a wonderful retirement because they have made the decisions to get them to that level of wealth. But the client shared with me, John, that he knows of a coworker of his that is the same age, that they started about the same time, and they had access to the same employer retirement plan. In this case, it's the TSP, which is a government retirement plan.
Right.
And they were talking the other day, and she had not been putting in, her coworker had not been putting in for all of those years, at least not very much, just enough to get the match. And he shared with me her status, because I guess they'd had a talk, and the same situation with roughly the same income for the same distance or same duration of employment, and she is not prepared for retirement. So you think about that in terms of, if you think you can't do it, you just look across the aisle at the guy that works with you and walks through a career with you and see how they may be doing it. It is available, but again, it shows you the difference in the decisions and what the impact that makes.
Scott, I'm going to lean on my years of experience in this business and talking with people all the time. it is the difference in being prepared and having I'm going to be prepared and be in control of my retirement, or a get by mentality. Well, I'm just going to do enough to get by. I'm going to do just enough to get the match that is applied to my employer retirement program. It's almost like they think it's a game, and that I'll just do just enough to kind of say that I'm doing it, and then you get the consequences that you get. You should not ever be upset about the consequences that you're getting because of the preparation that you failed to put in. And so that is the admonition that I would have to anyone listening to this show, is don't put yourself in a situation where you're down to your last dime. You can't do that. And that's really essentially what you are if you are in a situation where you don't have any source of retirement income except Social Security and a reverse mortgage.
So for Beverly, if someone is up against retirement and has little to no savings, a reverse mortgage might be the only option, but you, Beverly, still have options if you are 57 and you're not going to retire for the next 8 years, or potentially even longer. You could push off retirement. But the key is building a plan, creating a contribution, a systematic contribution to your retirement savings, finding out where that will land you at a future point in time, and then what that asset level will do for you in retirement income. That will answer some questions. I want to remind you to subscribe to our YouTube channel for exclusive content you can't find anywhere else to help you discover, protect, and share true financial independence. Just search for GenWealth Financial Advisors on YouTube. Our next question comes via email from Terry. I've been self-employed for years and never set up a formal retirement plan. At 55, is it too late to catch up, or should I just invest in a brokerage account? Another viewer or listener worried about catching up, and is it too late? So if you're behind on retirement as a self-employed pro, well, we've got some ways here to stop the drift and start a plan that fits your lifestyle. So there are several options. We've talked about them on the show before for a self-employed person. So I'll go through the first one here. And the SEP IRA is probably the first one that comes to mind if you are self-employed. This one is very easy to set up. It's as easy as opening that brokerage account, Terry, that you are referencing there. But instead of a brokerage account, which you're putting after-tax dollars into and then paying taxes as you sell investments if they have gains, and potentially even paying on interest and yields as well as you go, a SEP IRA allows you to get a tax benefit now for making the contributions, and you'll get tax-deferred growth along the way in your pre-retirement years leading up to taking it out. So the contributions in a SEP IRA, and this is very important, they're made from the employer side. So you as an employee of your business would not be making a contribution, but your employer side would be making the contribution. And it can be up to 25% of the employee income. So this very much hinges on how much you pay yourself. And we don't have any idea, just by telling us that you're self-employed, how your business is set up. But this does work very well for 1099 independent contractors, salespeople, like real estate agents who don't really know year to year what they're going to make, because you can put up to 25% of employee income up to a $70,000 cap. That's a lot of money. If you make a lot of money, you can make contributions for 2025 until the tax deadline next year. So again, that helps self-employed workers who have variable compensation, because they can actually let it all shake out through December 31st of this year and then look in January and see how much did I make and how much can I get into that SEP IRA. But one thing, it's best used if you have few to no other employees, because what you do for yourself, you've got to do for everybody else.
Yeah, it's a like percentage, not the like dollar amount, but a like percentage. But that can still be pretty costly to, someone. Maybe you've got an employee that makes $50,000 a year and you contribute, 20% of your income. You've got to contribute 20% of their salary to their SEP IRA. So it is best that if you do that only for if you got a high cash flow business and you want to be sure that you're very kind to your employees, or you just do it for yourself if you're self-employed. Scott, if you have employees, then a simple IRA is probably the first place I would direct people to take a look at. A simple IRA, I call it a stepchild to the 401k plan. It's sort of a junior 401k. There is a dollar for dollar match up to 3% of salary for the employer contribution. That is only if the employee makes a contribution. If the employee doesn't make a contribution, you are not obligated to make a contribution under this simple program like you would be the SEP program. But at any rate, the money grows tax deferred just like an IRA account does. The employee can make a contribution for themselves up to $20,000 a year. And so there's great benefit for that for a small business, has a few employees. You want to offer something, but then the employer has the opportunity to contribute 3% of their salary to themselves and make a contribution for themselves out of their own paycheck. So you've got that opportunity as well. The other thing that I would also mention that we can go down the road if you don't like the flavor of the SEP program that Scott talked about, there is also the solo 401k. This works really well if you and your wife or spouse work in a business together. You can have the individual and the spouse both on this solo 401k plan. It's not as complicated as a 401k, a full-blown 401k, and you can make even more contributions there. But wait, there's more.
Yes.
If you are a very highly compensated, say a doctor, a lawyer, a real estate agent, something like that, then you could go to a defined benefit plan with the help of a financial advisor and a third-party administrator, and you can make a big contribution to that. It is significant dollars. It's all based on your revenue from the business, but there are significant dollars that you can make to a contribution you can make to a defined benefit plan, all of that being tax deductible to you. And a bottom line is that you have the opportunity. You've got lots of options that you can go into if you are a self-employed individual.
Yeah, and he asked about, is it too late? It's not too late. At 55, we just talked about the lady before that asked a question about the reverse mortgage. She was 57. There's still time. And when you look at those limits, we mentioned the limits of the SEP IRA. The simple IRA, over 50, you can put $20,000 on the employee side into that because the limit is $16,500 and then a $3,500 catch-up if you're 50 or over. And the Secure Act 2.0 actually has now implemented even increased catch-ups for those 60 to 63. You can actually have a catch-up of $5,250 instead of the $3,500, which gives you a total of $21,750. And if you went the solo 401k route, those limits are the exact same as the corporate 401k accounts. The contributions are limits are $31,000 if you're 50 or over because of the $7,500 catch-up, and for 60 to 63, that catch-up is $11,250 for a total of $34,750. So again, the opportunity is there. The options are there. If you got serious about it at 55 and did it for a decade, we already did the math in the previous question, you can make an impact. So it's not too late. And I think that's the key here, John, is it's not a lack of opportunity, not a lack of options. You've just got to get serious about it and do it.
Absolutely. And there's a lot of information about small business that we're going to be conveying a little bit later on this year, Scott. I want to talk to our folks about an event that we're doing at the Delta Hotel just down the road from our West Little Rock office. If you have a business, we want to invite you to Built to Endure conference. It is October 5th at the Delta Hotel. Our guest speaker is going to be former Arkansas Razorback coach Houston Nutt. You go, well, what does Houston Nutt know about business? Well, he ran a business called the University of Arkansas football team for a while, and he was a great motivator. One of the things that we know is a big deal for businesses is that you've got to motivate your employees. You've got to create a team spirit with your company. And we've brought Houston in for this event to do just that. We've got a great lineup of speakers that are going to talk about all things business and retirement and all of that type of thing. It is on a Saturday, and so by the way, the Razorbacks are not playing. I think that
strategic,
probably part of Houston's contract that
yes.
he could sit and watch the game or what have you. But we've got an opportunity for you to be there, so you can actually go to our website and register for that in the not too distant future. We'll get that information out to you very quickly, but put that on your calendar. Save that date, October 5th at the Delta Hotel in West Little Rock.
Hey, we're going to call Terry's question the question of the week. Thanks for reaching out with it. We'll send you a Get Ready for the Future Show tumbler for being named the question of the week. Just send us an email to claim it, show@getreadyforthefuture.com. And if you're a business owner or if you're just wondering what can you do to catch up in your 50s, the key is to build a plan today. Get started right now by walking through the GenWealth Ready to Retire process. You can reach out to us in email form, show@getreadyforthefuture.com. The easier way is just to call us, 866-653-PLAN. It's 866-653-7526. Next, it's Donna from Jonesboro. We're 63 and thinking about converting part of our IRA to a Roth before RMDs hit. How do we know if it's the right time? Roth conversions, a lot of talk about that. That sounds smart. Timing is everything here. Do it wrong, and you could trigger a tax nightmare. You know, determining whether to do a Roth conversion is ultimately about two things, taxes and time. So let's break that out. First, the time piece, which Donna doesn't really have as much of at 63. If you have decades until retirement, you should definitely look at a Roth conversion because you have a long period of time to get that tax-free growth, and that can make a huge impact for you down the road in retirement. But at 63, that's limited, right? Doesn't mean you shouldn't do it, but we need to focus on the other thing, and that's taxes.
Yeah, the tax thing is a little bit dicey and tricky. You know, tax things are moving. We just had the big beautiful bill passed, and it kind of created some stability as far as the tax brackets are concerned. But Scott, you have to think about that if you are in your 60s, anytime you do a Roth conversion close to the age where you would draw Medicare, you have to think about the impact that Roth conversion could have on your IRMA surcharges that go against your Part B and Part D Medicare charges. If you have more income, then they charge you more for IRMA. If you have lower income, then you pay the regular rate for Part B and Part D. So if you do a big Roth conversion, then that sits right on top of your other income and is counted as taxable income to you, and it is included in that IRMA calculation. So you end up hoping to avoid taxes, but you end up getting backdoored by the tax bill on IRMA and on your Medicare. And so that's a real problem oftentimes when you get into the mid-60s area of wanting to do a Roth conversion. Now, obviously, if you're in a lower tax bracket right now and can convert funds and then get tax-free income later, that makes some sense. Or if you're thinking, I'd like to go ahead and get this taken care of for my heirs so they don't have to worry about it, that's a wonderful thing to think about. But is that the right move to make? It could be, could not be. I think it's very situational, but I don't think that the Roth IRA is the panacea that oftentimes the financial media seems to make it out to be. And oftentimes people talk about it like it's, oh, this is the way that you're going to save taxes. You're actually going to pay more taxes when you do a conversion because your taxable income is going to go up.
And the other piece, too, that people often forget in thinking about this is you really need to have the cash sitting on the sidelines to pay the taxes.
Absolutely.
Because you think about that. You don't want to sell the investments and take money out of the IRA to pay the taxes because that's a withdrawal. And it could come with extra penalties. If you're not 59 and a half, it's going to be a 10% extra penalty. Donna doesn't have to worry about that. But that's oftentimes a deal breaker for a lot of people, converting large amounts anyway, because they don't want to part with that cash or they don't have the cash to pay the taxes. So really, it needs to be a little more strategic, a scalpel instead of a machete here. Converting small amounts might make sense, and then looking into your early years of retirement to do it, because that might make sense too, as you might be living on less and be in a lower tax bracket. You know, most people, we retire, step off into retirement and live on some percentage that's less than what they were making in their working years.
Scott, I think the magic word or phrase would be to fill up the bracket.
Yeah.
And what we mean by that is that if you are in a tax bracket, let's say you're in the 22% tax bracket, and there is a threshold when you would cross over to the 24% tax bracket, but you're not there yet. You've got some room before you get there. You could maybe convert up to that dollar amount or just below that dollar amount, and you're not going to increase your percentage of taxes that you would pay. You'd pay the same percentage that you would pay on your other income. But if you exceed that threshold, then you're going to be paying a higher percentage on the tax above that dollar amount. So you don't want to violate the tax bracket in that way. But again, I think you have to think about, does it make sense to parse this out a little bit at the time from the taxable IRA account, or does it make sense to go ahead and do the conversion? I think the time is the factor there, because you get the tax-free growth over time in a Roth IRA, and that is the true benefit of converting a small amount of money and letting it run.
Yeah, and wrapping up the RMD part of that question, I think that really highlights a real need to begin some sort of strategy, whether it's converting to a Roth to get money out of the IRA, or just a withdrawal strategy in general, that you're using that money for your retirement. Because we haven't even really talked about, do you need some of that money between now and RMD age? For Donna at 63, you've actually got 12 years before the government's going to require you to take out those RMDs. 75 is going to be your RMD age. That's a lot of time to work with. You might create an income stream, pay the taxes on it, as long as you don't jump the bracket, and use that for your retirement rather than convert it into a Roth. Bottom line here is, Donna, you need to work with a financial advisor to build a retirement income plan that incorporates the tax planning, the potential of Roth conversions, and a withdrawal strategy that optimizes your total income without running you out of money. You don't want to make these decisions, as we kind of alluded to in the open, in a vacuum. It needs to be as part of a holistic, well-rounded financial plan.
Scott, I would imagine that if someone was just listening to that, they would go, wow, that's real complicated. That's the point. That's why we do what we do. Pick up the phone, give us a call here at GenWealth. Let us walk you through that. Let us help you to do that, because that's what we do all day, every day here at GenWealth, is we help people walk through the complexities of retirement, finance, all the things, and help you get on that road to financial independence.
You can reach out toll-free, no matter where you're listening or watching, 866-653-PLAN. It's 866-653-7526. Maybe you just got a question. We'll start there. We'll get you hooked up with a financial advisor and have a phone conversation. Maybe you're ready to actually come into the office and have that first appointment, which, by the way, costs you nothing to attend. 866-653-7526 to get the ball rolling. Our last question today on the show is from Melissa in Fayetteville. I'm 48 and earn too much to contribute to a Roth. Should I look into backdoor Roth strategies or just focus on my 401k? So you can't get into the Roth IRA. There may still be the side door or the back door if you know how to use it right, and there are some things you need to know about that, and we will get to that. But first, let's talk a little bit about your 401k. Does it have a Roth option? When you say just focus on the 401k, there are no income limits. And hear this clearly. There are no income limits on the Roth 401k. And believe it or not, I looked this up, John. According to CNBC, people are missing out on this. 93% now, 93% of 401k plans now offer Roth contributions, but only 21% of workers are taking advantage of that.
Yeah, that's a real miss by people, and I think really it's a real miss by maybe the 401k custodians and the employers by not educating their employees about this. This is something that we do at GenWealth. We help people to understand their benefits packages so they can take advantage of things like this. But if you have a Roth 401k option in your plan, then it's simply as easy as signing up for it. If you don't, then talk to HR, talk to the boss and say, hey, can we look into this? Because as Scott said, most plans have them. A vast majority of plans have them. If your plan hasn't been updated, it's probably not going to be very costly to do that, and it would be a great benefit for the employee. So I think you make a great point of focusing on what you may have at your fingertips and may just not realize it.
Now, if, Melissa, you make too much to contribute to the Roth IRA, you're a pretty high earner too, right? So you may want to split your 401k contributions, if you have that Roth option, between pre-tax and Roth, because tax savings now are still important if you're making that kind of money. And as we talked about earlier in the show, you generally will live on less in retirement. So deferring taxes now may save you more, but at the same time, having a large bucket of tax-free income in the Roth will be valuable too.
I want to make a point about that, Scott. I think you have to be intentional. Don't just throw some numbers at it and go,
Yeah.
oh, I'm going to do a little bit here and a little bit there. Be intentional about it. And the only way you can be intentional about it is if you have a plan. And I think you've got to, that plan, as you said, it's got to be kind of almost double-minded. You've got to think about, how can I save some money on taxes now? And then how can I create another stream of tax-free income in my retirement? I will tell you, and you know this from working closely with clients for the last 8 or 9 years that you've been here at GenWealth, Scott, it is always a plus if you have a bucket of tax-free money
Yes.
for those once in a blue moon expenditures, like I'm going to take a big trip, or I'm going to buy a car and pay cash for it, or what have you. If you have to take that money out of your qualified money, meaning your pre-tax money, then you've got to take out probably 20 or 30% more money to pay the tax on it to get the net amount of money that you need for that purchase. If you have a Roth account, then you can just go get the money and you don't have to worry about the taxes.
So let's talk a little bit about, in the last couple of minutes we have here, how that backdoor Roth works. So Melissa asked about backdoor Roth strategies, and here's how it works. So you make contributions to a traditional IRA and then convert the funds to the Roth. Now, we talked about conversions earlier. Well, isn't that a big tax problem? Well, if you do this before investing the funds, there really wouldn't be any taxes due because there are no gains. However, if you have other traditional IRA funds, this is probably going to be a full stop because you are going to want to pump the brakes. The IRA aggregation rule means you have to count all of your non-Roth IRA dollars when converting. So if you have an IRA, for example, that has $70,000 in pre-tax money and $30,000 in after-tax money, 70% of any converted amount would be considered pre-tax. So in other words, if you have other IRA money, this is probably not a strategy you want to employ. It works best for people who have all their money in their 401k. They do not have a traditional IRA. That's when a backdoor Roth makes sense.
Yeah, and I think that that's certainly a strategy that you may want to consider, but I'm going to go right back to this employer thing again because I think that there's probably an Easter egg hiding right there that all you got to do is go reach and pick it up.
Yeah.
And if that's not the case, then maybe just a conversation with your employer and getting them to update the plan to offer a Roth option. I've got to believe that the vast majority of custodians would be like jumping through hoops to try to help an employer get that done if that is the case. But Scott, I think that we can't stress enough the value of a Roth IRA in retirement. And I want to go back to maybe the younger listeners that are listening to this show. Putting away money into a Roth IRA right now, if you change jobs, let's just say that you've got $10,000 in a 401k and you end up changing jobs. Roll that 401k over into a Roth IRA, pay the tax on that $10,000 right now, then let it compound the rest of your life and see where that gets you in terms of tax-free income in retirement. It is one of the greatest opportunities, I believe, that most people have to create financial independence for themselves, because here's what you're really doing. You're really cutting Uncle Sam out of about 20 or 30% of your retirement income going forward when you retire, because you're going to have tax-free income from the Roth as opposed to taxable income from a traditional 401k or IRA account.
Well, they hung on there and waited to sound the bell.
They were waiting for me to shut up.
Yeah,
That's
we're
what
waiting
the
for
deal
you
was.
to finish your point, but we're going to go right back to you. We're running out of time on the Get Ready for the Future show. We have about 90 seconds left. Time to wrap this thing up.
Scott, I just believe that people have not because they ask not. And what I mean by that is they don't stop and take the time to be really big picture oriented about their finances. They react to this particular situation or that particular situation. It is a lot like our planning process. You know, when we have clients call us and say, what do we do about the market? It just did this. We planned for it ahead of time. We went ahead and built your plan to accommodate that. You have to think about your personal financial planning like that you want to build your plan to accommodate certain things, like having tax-free income, like not being in a situation where you have to milk the equity out of your house to try to get some extra retirement income because you haven't saved. All of those things are preventable if you do the preparation ahead of time. And I think that's the real value of financial planning, is to be able to prepare ahead of time for what may be coming down the pike, regardless of what age you are. And if you're getting ready to retire, that planning is even more critical.
And here's how to reach out to begin going through the GenWealth Ready to Retire process. The first appointment is complimentary. To schedule it, email us at show@getreadyforthefuture.com or call us toll-free 866-653-PLAN. That's 866-653-7526. And that is all the time we have for this week's Get Ready for the Future show. It always flies by. If you'd like to get in on the action and ask us a question, all you have to do is remember this number. Write it down, 501-381-5228. You can send us a text or leave us a voicemail at that number, and we'll play your question on the air.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.